You think you can outsmart the stock market. You think you can figure out exactly when to buy low and sell high. And honestly, that confidence might be the most expensive mistake you ever make. Let me tell you about my neighbor Dave. Dave is the kind of guy who watches the weather forecast obsessively before planning a barbecue. He checks 3 different apps, looks at historical weather patterns for that specific weekend, reads forums where weather enthusiasts argue about pressure systems, and every single time, without fail, he either cancels the barbecue because rain was predicted and it ends up being sunny, or he goes ahead with it and gets completely drenched. Dave is convinced that if he just gathers enough information and watches closely enough, he can predict the weather perfectly. He never can. And here is the thing. Dave is also an investor, and he approaches the stock market exactly the same way. This is what we call timing the market. And today, I want to show you exactly why it is one of the biggest traps that beginner investors fall into, why even the smartest professionals in the world cannot do it consistently, and what you should be doing instead. So first, let us define what timing the market actually means. Timing the market is the strategy of trying to predict when stock prices will go up or go down, and then buying or selling based on those predictions. It sounds completely logical on the surface. Buy before prices rise, sell before they fall. Simple, right? The problem is that in practice, this is extraordinarily difficult to execute successfully, not just once, but consistently over time. Here is the barbecue analogy fully cooked. Think of the stock market as the weather. Sometimes it is sunny, meaning prices are going up. Sometimes it storms, meaning prices are crashing. Now imagine you only wanted to go outside on perfect sunny days and stay inside during every storm. That sounds reasonable. But here is where it gets complicated. Weather changes fast and without warning. A morning that looks absolutely clear can turn into an afternoon thunderstorm. And in investing, some of the biggest single-day gains in the market happen right in the middle of what everyone thought was a terrible storm. In fact, many of the best-performing days in stock market history happen during or immediately after periods of major crisis and fear. If you were sitting inside waiting for the storm to pass, you missed those gains entirely. Now here is where the math becomes really uncomfortable. Studies have shown that if you were invested in the stock market over a long period, say 20 years, but you missed just the 10 best single days in that entire 20-year stretch, your overall returns would be cut nearly in half, missing 10 days out of roughly 5,000 trading days. That is it. And those 10 days are almost impossible to predict in advance. So what happens in real life? An investor watches the news, gets nervous, pulls their money out to avoid the incoming storm. The market dips a little, they feel smart. Then suddenly on a random Tuesday, the market explodes upward. They are still sitting on the sideline. They wait for it to come back down before getting back in. It does not come back down to where they expected. So they either miss the recovery entirely, or they eventually jump back in near the top, right before the next dip. This cycle is not a beginner mistake. It happens to professional fund managers with teams of analysts, Bloomberg terminals, and decades of experience. Research consistently shows that the vast majority of actively managed funds, where professionals are literally paid to time the market and pick the right moments, underperform a simple index fund over long periods of time. Think about that. The people whose entire job is to outsmart the market mostly cannot do it reliably. And there is a psychological reason for this that goes deeper than just math. Our brains are wired to respond to fear and excitement. When markets drop and everyone around you is panicking, every instinct in your body screams, sell, get out, protect yourself. And when markets are booming and your friend is bragging about his portfolio at every dinner party, every instinct screams, buy, jump in, you are missing out. These emotional signals feel like wisdom. They feel like data, but they are almost always leading you in exactly the wrong direction at exactly the wrong time. This is what psychologists call herd behavior. We look to others to figure out what is safe. In the wild, if everyone in your group starts running, you run too, because something dangerous is probably coming. That instinct kept our ancestors alive. In investing, that same instinct causes you to sell at the bottom and buy at the top. It is the financial equivalent of running toward the fire, because everyone else just started running that direction. So what do you do instead? Here is where we introduce the concept that beats timing the market almost every single time for regular investors. It is called time in the market. Notice the subtle difference. Instead of timing the market, you spend time in the market. The strategy is simple. You invest regularly, consistently, regardless of what the market is doing. Rain or shine, You show up for the barbecue. You bring your contribution. You stay invested. And you do not panic when clouds appear. This approach has a formal name, which is dollar cost averaging. But you do not need to remember the term. Just remember the idea: consistent, patient, long-term investing. Back to our weather analogy. Instead of trying to only go outside on perfect days, you dress appropriately for all weather and go outside every single day. Sometimes you get rained on, but over a full year, you spent far more time outside enjoying sunshine than the person who stayed inside waiting for perfect conditions, who ended up going outside maybe a handful of times and still got caught in unexpected rain at least once. Over long periods, stock markets have historically trended upward despite crashes, recessions, pandemics, and political crises. An investor who stayed consistently invested through all of those storms ended up significantly better off than one who tried to dodge each storm individually. Now you might be thinking, but what about when a crash is really obvious? What about when everyone knows something bad is coming? Here is the brutal truth. By the time it feels obvious to you, it is already priced into the market. Millions of professional investors, algorithms, and institutional traders have already acted on that information before you finished reading the headline. The market is not waiting for your permission to move. This does not mean investing is reckless, or that you just blindly throw money into anything. It means that your job as a beginner investor is not to be the smartest person in the room who predicts the future. Your job is to be the most patient person in the room who stays invested long enough to let the power of compounding do the heavy lifting for you. Here is your takeaway from today. The market is the weather. You cannot control it, and you cannot predict it with any reliable consistency. Trying to time it perfectly will leave you cold, wet, and missing out on the best days. But if you just commit to showing up consistently, dressed for all conditions, investing regularly regardless of the forecast, history strongly suggests you will come out ahead of the person obsessively checking 3 weather apps and still getting it wrong. Dave is going to throw that barbecue again this summer. He is going to check every app he can find. He is going to analyze the pressure systems. And the clouds will probably do whatever they want anyway. Do not be Dave with your money. Be the person who puts the grill on regardless, trusts the long-term forecast, and enjoys the cookout. Start early. Stay consistent. Resist the urge to be clever. That is how regular people build real wealth over time.